Good morning. My name is Matt Thompson. I am the market leader for business banking for Minnesota, South Dakota, North Dakota. A little weather this morning, which I'm sure people in North Dakota are like laughing at us because they had like 8 inches, I think, last week. But we made it. Jeff, how many years have we done this? I don't even know.
This is about the sixth year.
6 years. This is our second year with snow. So anyway, welcome again. U.S. Bank, obviously that's commercial real estate loans as well. I've done two 1031s myself with Jeff, so which makes you think it's more than 6 years, Jeff. It's got to be like 8 or 9. Referred a lot of clients to Jeff Commercial Partners, does a very good job in 1031s, and I'm going to stop talking and let the expert get going here. For those in the crowd, we will be doing a Q&A at some point in time throughout this. I'll be the man on the mic. If you have questions online, you have to have my cell phone or Teams me to text me that question. So with that, Jeff, you ready to go?
I'm ready. Let's do it, Matt. I'm so excited to be here. We've got like almost 120 people online watching this on a webinar through Zoom. I want to thank my man Stefan, who is our AV audio video recording guy. Stefan, can you raise your hand? If anyone ever needs an audio video guy, he is the guy to go to. And he also does some social media stuff if you want to be on Instagram. So I'm not supposed to move around too much, but that's not my normal mode of operation. I'll try to stay closer to the front here. I am Jeff Peterson. I am an attorney licensed to practice in the state of Minnesota. And for about the last 27 years, my central focus has been facilitating 1031 exchanges. I'm humbly acting as a servant, facilitating exchanges. I am in the trenches every day helping people. And through that experience, I've gained a lot of practical wisdom and passion for this 1031 provision. Today, we're going to be talking about advanced strategies. This is not designed to be talking about the nuts and bolts basics. We can weave some of that into this, but we want to talk about advanced strategies. I believe that the mind is the maker. And if you plan to succeed, then you're going to probably succeed. If you don't have a plan, well, you might stumble into success, but it's not as likely. So I want you to learn some strategies that then you can implement over a long course of time, perhaps, to gain that success that you want to have in real estate. We have attendees here in this room that have traveled from other states. We've had people that have traveled long and hard through a tough winter storm that we just had our first one here in Minneapolis. So I want to thank everyone that has come physically to attend, and I also want to thank our many online attendees who are watching through Zoom webinars. If you have a question, and I encourage you to ask questions, please feel free to do so. Know that you may be recorded and on video, and that Matt Thompson is probably going to want to bring the microphone over to you so you can ask the question. We've got a great PowerPoint deck, but if you've seen me speak before, I'm all over the place, and I'll go down any rabbit hole you want to go down anytime, no matter what the PowerPoint slides say. So those are the rules. There are no rules. Ask questions, make comments. Let's have fun. Congress enacted the first predecessor to 1031. In that code section, they allowed for the exchange of property tax deferred. And it was a law that came about after World War I, where the United States had just spent a lot of money fighting a war in Europe, and they had increased taxes during the war to fund the war effort. After the war was done, they needed to find a way to stimulate the economy to dig themselves out of the debt that they had incurred. The first iteration of 1031 allowed the swapping of properties to occur. That provision didn't just relate to real estate at the time. That provision allowed for the exchange of properties, but it was anticipated to be a simultaneous swap. So in 1921, people were trading horses. I'll trade you my horse, you trade me my horse, and we do an old-fashioned horse swap. Over time, that modality evolved into what we call the deferred exchange modality. In the 1970s, there was a scallywag named T.J. Starker. Oh, by the way, I love this little piece of history. This same provision from 1921 also gave us the carryover in basis when you give gifts. In this provision, it enacted the carryover basis. So not only do you get the property from the grantor, but you also get a carryover basis on inter vivos gifts. And it also increased or created the step up in basis provision. So that's really neat history. Also, at the time, the marginal tax rates in 1921, because we've been fighting a war, were as high as 73%. How many people would like to pay 73% income tax? I wouldn't get out of bed. Like, why to go to work? I'm going to give away 3/4 of it, right? My wife will take the other quarter, and I won't have anything left. Okay. This provision that allowed for the deferral of tax on swaps was really intended to promote transfers. We didn't want people to be locked in. We wanted capital to flow to the most advantageous investment. That stimulates the economy. It creates jobs. It does things that we want, but it also helps investors. So I got to give you the lawyerly disclaimer because the rules of professional conduct require me to tell you that I am an attorney, but I'm not creating an attorney-client relationship with anyone. This is really intended to be an educational seminar. So people are going to have questions about their own specific situations. In those situations, it's best to talk to your own accountant or lawyer that knows your historical background. Anything I tell you off the cuff today shouldn't be treated as legal or tax advice. And then I just want to mention, the state of Minnesota makes it really hard to get CE credits approved, so we're not offering any CE credits for real estate agents or for attorneys or CPAs. So here's that code section, 1031. 2018, they added real property. They said real property is the only thing that can be exchanged. Before that, we were doing exchanges of aircraft, tugboats, business equipment, forklifts. We were doing personal property exchanges. That was a lot of fun, particularly in the realm of aircraft. And I'm wondering if in the future we're going to see a return of the exchangeability of personalty, chattel, when the bonus depreciation provisions fully burn off. There's going to be some crying when you can no longer fully write off your new personalty that you're buying. Notice that there's really two litmus tests. The properties have to be held for investment or business purposes, and you have to exchange for like-kind property. Let me just briefly tell you the two areas where we see properties not qualifying. If you own a lake cabin, you may have a property that's used for your own personal edification. That property isn't an investment or business property. Even though you may want it to go up in value, your personal use of the property trumps the purported investment intent. There have been a lot of cases where people have fought with the IRS about their appreciated personal property, and the IRS has been making a point of winning those cases. In the area of Airbnb VBRO, though, the IRS has granted a very broad and generous safe harbor, if you will, for properties that are used primarily for intermittent rental, the rental programs. In that safe harbor, the IRS will look at the first 2 12-month periods after you buy the property to decide if you have used the property primarily for investment or business. So they're going to test those 2 12-month periods to see that A, you've minimally rented it at least 14 days a year, and B, you haven't used it more than 14 days a year or more than 10% of the time the property's been rented out. So on your use side, you could use it 14 days, or let's say the property was rented out for 300 days. You could use it 29 days because that would be under the 10% threshold. I tell people, why be cute? Just keep the thing rented out for the next 2 years. Consider yourself on 1031 probation If you're going to go somewhere, just don't stay in your own unit. Keep yours rented for the first 2 years until you get that 2 years satisfied. I think the state of Minnesota likes to audit personal use properties, lake cabins, ski chalets, oceanfront condos. So we need to be extra careful when you're in a kind of an aggressive tax collecting state like Minnesota. If you're in California or New York, you have to be even more careful. The other property that doesn't qualify, and this is sad news for the flippers, is property that has been held primarily for resale. So if you buy an apartment building and you convert that thing to condos and you peddle each of those individual units to the public, you're a dealer. That real estate is your product. It's your stock and trade, and you can't do a 1031 exchange on your dealer property that you intend to hold for resale. Same thing with land developers that are buying up land and cutting it up into little quarter-acre lots and selling it to residential home builders and so forth. It's their inventory. So you got to be careful. You can change the way that you do business. Rather than buy, put the lipstick on, and quickly sell, and end up paying ordinary income rates on your flips, why not buy the property, rent it out for a year or more? The longer you rent it, the more you could substantiate that your intention, your mens rea, was to hold it for investment or business. After you've seasoned it as an investment property, then you can do your beautification, put the lipstick on the property, and then sell it in a tax-deferred exchange, taking your gains and redeploying them into other investment or business properties that you may season for another substantial period of time. Questions or comments about the general language of the code section? We feeling good? All right. Let's talk history. We talked about 1921, the first iteration of the code. The numbering system has changed. In 1954, 1939, we had numbering in the code system. In 86, we had the last major overhaul. So we're under the income tax of 1986. In section 1031 is what we use as the numeric signifier for this provision. This guy named Starker was a lumber baron in Oregon. He had lots of appreciated real estate, and people wanted to buy it, but he didn't want to pay taxes. So he said, I'll sell you these lands, Mr. Buyer, but you need to give me back some real estate in exchange. I will designate that real estate in the future. So this blew everyone's mind. It was a non-simultaneous exchange. He was giving up his old land for new land that he would designate in the future. Case goes all the way to the Supreme Court. T.J. Starker wins the case on a procedural argument, but a win's a win. And that case became the precedent for opening up the floodgates for non-simultaneous exchanges. This made the Internal Revenue Service and Treasury very nervous because there were no guardrails on 1031 to constrain the process. And so Congress gave the Internal Revenue Service and Treasury the authority to write their regs, their own regs. So they got to write the rules for what they're going to administer. In 84, they added stuff. 84, they excluded partnerships from 1031 treatment, which was a big event. And they added the 45-day identification period and the 180-day exchange period. So now, when you do a 1031 exchange, a delayed exchange, you have to identify by midnight of the 45th day what properties you want to purchase. That rule was not written with your success in mind. One strategic strategy is to act like a chess player. Think 2 moves ahead. Before you even sell your relinquished property, what's a prudent idea? Find what you want to buy first, lock it up, maybe even put the property under contract or LOI or have an option agreement, but have your for sure thing lined up. Okay, now you are a chess player, but you're playing at a higher level than everyone else in the room. You also have a backup plan. What if the property that you had wanted to buy turns out to be no good when you do the due diligence? Having another plan, a plan B, in addition to the property you've locked up might be a good idea. What kind of product might work as a good backup in the event that your first choice doesn't work out? The syndicators of real estate, big firms like Morgan Stanley, Ameriprise, Cantor Fitzgerald, RBC Wealth Management, even US Bank Wealth Management, have products that are sold and regulated as securities. And we're going to see the slides later, but these products are typically referred to as DSTs, Delaware Statutory Trusts. When you own a beneficial interest in a DST, you are deemed to own your proportionate share of the underlying real estate of the DST, and you're deemed to take subject to the underlying debt that's allocable to you, your portion of the debt. So backup plan number 1 might be to find a DST that you could list as your backup choice. We'll talk about what the attributes of a good backup are. Are there any other product types that you can think of that would remain on the shelf and available to you as a backup? Let's say you have a best friend that owns an apartment building. And you say to the friend, I'm going to be vulnerable for a little while. I'm going to be doing a 1031 exchange. I'm hoping that my first choice doesn't fall out of bed. And your friend might say to you, well, if all else fails, I could sell you this apartment building. So sometimes you can have an arrangement with someone, say, hey, I'll buy that 40-acre farm that you have or that 10-unit apartment building or whatever. People think and talk amongst their friends and colleagues and sometimes help each other out when the first choice, the second choice, and now the third choice has to be activated. All right, my business is that of a qualified intermediary. The Treasury regulations that were written to regulate this industry created certain safe harbors for facilitating these exchanges, these delayed exchanges. Before these regulations were issued, there were all kinds of crazy 3-party arrangements, 2-party arrangements to create an exchange. This qualified intermediary modality has become the dominant safe harbor and has spawned an entire industry of intermediaries that facilitate exchanges. So what is a qualified intermediary? Is it a person that can give you tax and legal advice? No. It needs to be a person that is unbeholden to you, neutral. Anyone that has been your agent, your attorney, your accountant, your relative, anyone that you trust and like in life is pretty much disqualified from being your intermediary because they'd be beholden to you. You would have sway over them. So your mother can't be your intermediary because she's related to you. Your employee can't be an intermediary because you are their employer. You are the master, they are the servant. The party has to be neutral, unbeholden. And that's what we do, is we act as a third-party administrator to facilitate exchanges. And while we're very good at what we do, there's a limit to how much we can do. I say to people, it takes a village to raise a 1031. And people kind of snicker, oh, ha, that's funny. But you do need to involve your whole team. Having a great banker, a great accountant, a great real estate broker, a great title company. Having your team assembled is going to help you, because if there's a deficit on your team, someone's going to have to shore up that deficit. You don't want to have to be the person to shore up the deficit. You want to be making the most informed and correct decisions when you're doing an exchange. When you do a 1031 exchange, it's prudent to put a clause in that contract, the sale of your relinquished property, notifying the buyer and any other parties to the agreement that you're doing a 1031, affirmatively stating it, not wishy-washy, not may do an exchange. I'm doing an exchange. This is part of an interdependent plan to effect an exchange. Mr. Buyer, I'm going to be assigning my rights in this contract to my intermediary. You agree to cooperate by signing an acknowledgement that you received that written notice of my assignment to the intermediary. How can I prove that I gave you written notice if I don't get something acknowledged by you that you got that written notice? These regulations contemplate that the intermediary is either going to actually take title to your property and then sell it to the buyer, or is going to synthetically receive your property and then sell it to the buyer. Synthetically meaning we're taking an assignment of the seller's rights in the contract and then direct deeding and directing the seller to convey it to the buyer. Under the old English common law rules, an assignment was not effective until all of the other parties to the contract were given written notice. That's why we want to give you written notice, Mr. Buyer. And we want to be able to prove we gave you that requisite notice, so we want you to sign something at closing. So here's a strategy. When you're dealing with buyers and you're in the strong position, the strong negotiating position, you put it in the contract what you want them to do, you tell them what they're going to do, and then everyone agrees to it at the outset. Because sometimes you'll give a notice to a buyer at a closing table, and they don't know what an exchange is, and they're mad at the seller. You scraped the wall on the front entranceway and it wasn't fixed before closing. Or I don't like the fees that are being prorated, or whatever it is that's bothering them. They're usually exasperated, they're tired, they're worn out, now they're at a closing and they're signing paperwork that they don't fully understand, and they can sometimes freak out, especially in a sort of resi commercial context. You want that buyer to be committed to signing your 1031 docs from the outset. If they have a tantrum at the closing table, their real estate agent can take them out in the hallway and say, look, you agreed to this in the contract. Just sign the paperwork. It doesn't affect you. It's for the 1031. So plan ahead and plan to succeed and plan to have a smooth, silky closing that goes off without a hitch. Speaking of smooth and silky closings, I want to thank our sponsor today, Guarantee Commercial Title in downtown Minneapolis, and Kathleen, who has been so instrumental in helping promote this event. The fact that this room is full of people is a testament to our synergies with them, so thank you. Also, I want to thank the many other title executives that are in the room today as well, and friends. All right. The qualified intermediary in the regulations is deemed to not be the agent of the taxpayer. That is in the regs. If you're going to pick somebody to do something specific for your 1031 exchange, the qualified intermediary is probably the safest party to interact with. And I'm talking now in the context of reverse exchanges and build-to-suit exchanges. If you need a surrogate to buy the replacement property first in a reverse exchange under Rev Proc 2037, your best friend from high school is probably not the best straw man to purchase the property, because your best friend from high school will probably be deemed to be your agent, your patsy. Whereas the intermediary is not considered your agent. So who do you want to have buy the replacement property and park it for up to 180 days while you go about getting your relinquished property sold? Who are you going to call? The 1031 intermediary. Who do you want to take title to the property while you have real property improvements constructed, so that you're receiving a replacement property that exists as real estate and is hopefully of equal or greater value and equity? Somebody has to hold title to that property to insulate you from receiving it prematurely. Who are you going to call to do that? Not your best friend from high school, not your agent, but the intermediary. That's the safe play. I'm emphasizing that because while I was in San Diego, I talked to a taxpayer who had pretty much arranged, and was pretty far down the road, of having basically a friend act as their surrogate to buy the property and hold it. Not to mention the fact that there are related party rules that we're going to be discussing today that complicate transactions when you're buying from a related person. Questions and thoughts about that? All right. Look at this beautiful timeline, this linear timeline. You've got 45 days after the close of escrow, so the day of closing is day 0. By midnight of the 45th day, you need to have sent in the identification. Technically, you can send in your identification to persons other than the intermediary, although that's maybe a little irregular, but it happens that you might identify to the seller of the replacement property or to the title or escrow officer that closed your transaction. You can identify to people that were involved in the transaction but were not your agent, like your real estate agent is your agent. Most of the time we get these identifications in, we countersign them and date them, we scan them into the system, and then we send them back to the taxpayer, as well as to their advisors and accountants if necessary, so that everybody knows the identification was achieved and completed timely. Question, Andy.
I know most people know the 45-day that they have to identify 3 properties, correct? And then do they get confused that then they have another 180 days on top of that to close?
People get confused about these rules because they're not doing 1031 exchanges all the time. In fact, they don't have another 180 days. But they hear things and they see things on the internet and they conflate the rules. So it's 45 days and 180 days running concurrently. But you know, there's even a bigger trap for the unwary than that. And that is this red text on the bottom left-hand side of the screen. If your due date for the filing of your federal income tax return pops up within that 180-day period, the IRS wants to shorten your exchange period to the shorter period, the due date for the filing of your income tax return. So if you start your exchange on December 28th and you file on April 15th, you're not going to get the full breadth and extent of your 180-day period, because that will go on beyond the April 15th filing deadline. So what do if you need the full extent of your 180-day period? You file an extension. Does the left hand and the right hand always work together? In other words, you may have a real estate attorney that's coaching you through this 1031 process, and nobody has called the accountant to let them know that you're in the midst of completing an exchange and the purchase of the replacement property is dragging on. It's incumbent upon you to let your accountant know, tap the brakes. Don't file the tax return until we're done with the exchange. Ask for an extension. A good real estate agent or a good accountant or advisor is going to know to let the whole cadre of advisors know we need to file an extension. Matt, there's a question in the back.
Jeff, can you just talk about that idea again of identifying to somebody other than the QI? Let's say I'm a syndicator and I had a client who said they were going to buy into one of our DSTs. They forgot to identify, and now they want to close into our DST.
That's a really good question. Let's talk about the basic rules for identifying. It has to be in writing. So maybe they sent you something in writing that says, I'm buying such and such DST or syndication. It has to be signed by the taxpayer. So maybe they signed it with a scrawled signature. Maybe they had an email signature block. What is a signature these days? I don't know. When these regs were written, it was in the 80s. Email really wasn't that commonplace. So it has to clearly describe the property. That can be by distinctive name. Perhaps DST, such and such is a distinctive name. So yes, you could potentially identify to the seller of the replacement property. I will tell you another prudent reason that I like to see a strong cooperation clause in the replacement property contract is that the purchase agreement itself could constitute an identification. It's in writing, it's signed by the purchaser, it clearly describes the property, and if you put a very strong affirmative clause that the purchaser intends to purchase this property to complete an exchange as part of an interdependent plan to defer taxes, I think you got it made. As a backup to identifying to the intermediary, you may have identified to the seller. I think that the question is an identification that is submitted in an email, the body of an email, does the email signature constitute a signature? At the bottom of your email, do you often have a signature block? And does it have your name in the signature block? Okay. In 1944, if you were serving in the Army and you wrote a letter back to your friends, oftentimes people would sign the letters. That was the custom, right? Now the custom today is to have an email signature. You don't typically make a scrawled signature and stick it in every one of your emails like you did in the 1940s. So I think that probably is an electronic signature. Is it an affirmation that you're putting your name to this communication? I think it is. But who knows? I'm not 100% sure because there hasn't been a case to litigate it. Great question, though.
Hey, Jeff, we have an online question from Ron Jones, who's normally here. All right, the question is, does this 180 days apply to our verse 1031 as well? And we're being told, can you repeat the question for the online people, too?
Matt and I will do a better job to get the microphone out to the audience. We knew that that was something we had to discipline ourselves to do, and we'll try to repeat questions for our online viewers, who are extensive and numerous. There's two ways to do a reverse exchange. Under the safe harbor in Rev Proc 2037, you're capped at parking the property for 180 days. It is the most friendly of safe harbors. Under that safe harbor, you can manage construction or manage the property. You can advance the money to the intermediary to purchase the property, or you can arrange for the financing. It is a very taxpayer-friendly safe harbor, but it's capped at 180 days. What if you want to do a reverse construction exchange? and you want to build the Taj Mahal of improvements. You're going to build $300 million of improvements. Can you get that done in 180 days? So you may want to enter into a parking arrangement that goes beyond 180 days, outside of the safe harbor. There's a famous, notorious case called Estate of Bartel, where the parking arrangement was like 17 months. A drugstore operator was going to move their location from an interior strip mall location to an external pad site location. They wanted to build brand new improvements to their exact specifications. It took 17 months to build the property. The intermediary holding title really had no economic risk. And the IRS attacked this non-safe harbor transaction because they said the intermediary's entity didn't have any risk, didn't have any benefits and burdens of ownership. It was merely a facilitator. The tax court said, so what? 1031 allows for the deferral of gains. Doesn't matter if it was merely a facilitator, didn't have the benefits and burdens. The IRS clearly got their clocks cleaned on that case. The IRS and the Treasury did not appeal that decision. They were afraid they were going to lose again at the appeal level. But they did file a notice of non-acquiescence that they didn't like the case. Why do I tell you this whole story? Because non-safe harbor exchanges do not have the same certainty of tax treatment as a safe harbor exchange. You have to think long and hard of whether or not you want to go outside of the safe harbor and do something longer than 180 days. Do you want to do a non-safe harbor? I'm your guy, but let's make sure that you've got the appropriate team built to advise you of the risks and the alternatives. Great questions. I get a lot of calls from accountants. Sometimes the call is really sad. This is what it is. I didn't know my client was doing a 1031 exchange, and I timely filed their tax return before they completed the closing of the replacement property, effectively shutting their exchange down early. And they want to know if they can amend the tax return to include the replacement property. So if you're an accountant, you're a CPA, make it part of your process to ask the client if they're in the midst of an exchange. I send a written letter out to the taxpayer that says, here's your 45-day deadline, estimated. Here is your 180-day deadline, estimated. And it appears this date is after your April 15th filing deadline. Please consult with your tax preparer about doing an extension if you need the full 180. It's a sad day when you get a call. So save your clients bacon, help them out, because they might need that help. All right, this is a little heady, but in the ivory tower, the aristocrats of 1031, those big thinkers, typically tax attorneys, are wondering about whether or not there could be an extension of the 45-day or 180-day period if your exchange ends on a weekend or a federal holiday. And the practice in our industry is to not anticipate that there's any extensions, that the 45th day is the 45th day and the 180th day is the 180th day. But I should mention that there is a small minority of high-level thinkers that argue that there is an extension permitted under the code. In the initial proposed regulations for 1031, they specifically said in the proposed regs that these extensions did not apply. These extensions are related to Section 7503 that allow for the extension. They then pulled that out because they thought that it wasn't even applicable, that they didn't need to say it because those extensions are only for administrative filings. But there is a small minority of people that think that you can identify on day 46 if it landed on a weekend or a holiday. So I should mention that that exists. There is some difference in our understandings of what the rules are. Until we see a case litigating it, though, I wouldn't rely on it. I would identify by your calendar 45 and complete by your calendar 180. The only exception to that is if you're in a federally declared disaster area. If you're affected directly by a hurricane, a forest fire, earthquake, some presidentially declared disaster, you may have some special provisions to complete your exchange at a later time.
I was just going to ask what you mean by if you are in a federally declared disaster zone. Does that mean if I live in the zone, in my property, my relinquished property is in California, or if I'm trying to buy a property in California, what constitutes being in the zone?
The question is, how do you know if you're in the disaster zone? For example, there was a COVID extension. I guess we were all in that extension, right? If your replacement property is flooded with 10 feet of water because you owned it in Sarasota, Florida, and they're hit by a hurricane or something, you don't necessarily have to be physically in the disaster area, but if the property you had it designated was, or the title company was, you may still be eligible for the extension. So everybody really needs to look at each of these extensions that are issued and read them carefully to figure out how you may be eligible for the extension. It may be that the property that you were intending to buy was in the disaster, but you yourself were not. Or your attorney or your bank that's financing your loan was delayed because of the extension or because of the event. So it's usually pretty broadly interpreted, to be quite honest. But you have to look at each and every disaster extension notice because they're not all the same. Particularly the COVID one was really peculiar. Good question.
Okay, Jeff, we have another online question.
Okay.
And I'm told the mic's picking up the questions now, so we're good there. So no more repeating, I think. Question on 1031 exchange. For example, I sell under a contract for deed with the percentage down and the balance paid in a balloon in 5 years after. Can this sale be exchanged?
First of all, I'll give you the disclaimer that every contract is written differently. There's a lot of different ways to write a contract. I'm going to give you the general answer. When you enter into a contract for deed, someplace they call it a land contract or executory contract, depending on what part of the country you're in, you're effectively conveying equitable title to the buyer. You're giving them possession of the property. They're taking the risk of loss if the property is destroyed. They're typically, the vendee on a contract has to pay the property taxes, the insurance, either directly or indirectly. They're the owner for tax purposes. Think about who takes the depreciation deductions on the property that was purchased on a contract for deed. The vendee does, generally speaking, because they are in possession of the property. They have the rights to utilize the property. When you're a vendor on a contract for deed, you're selling the property with an installment sale. You're retaining the bare legal title as an enforcement mechanism to compel the vendee to make sure they make their monthly payments, or whatever their payments are, to make that balloon payment at the end. You're retaining the bare legal title, but you have effectively given equitable title for tax purposes to the vendee. So you basically sold the farm when you entered into the contract for deed. 5 years from now, when you get paid off on the balloon, you probably cannot do a 1031 when you're merely giving the legal title to the buyer to satisfy the financing arrangement that was your installment sale. So how do you work around this bad fact of having conveyed equitable title? Well, the first option is don't do seller-back financing. It complicates your exchange. That's not a real good answer, particularly when interest rates rise fast. What you could do, let's say you're selling your duplex for $500,000, the buyer's giving you $100,000 down at closing, and you're financing $400,000 for 5 years. One way to fix this problem is to have the vendee bring their $100,000 in and have Mr. Vendor bring in $400K out of his own pocket. I'm looking at you. Because if you bring in the cash out of your own pocket to loan to the buyer, that means I'll still get the same amount of funds in my exchange account as I normally would get if there wasn't seller-backed financing. So having the exchangor finance the buyer out of pocket is a great way to fix the problem, but that requires you to have some liquidity. In the Uptown area, there's a real estate broker that acts as sort of a problem solver for sellers. You want a clean break. You don't want to do seller-backed financing, and you don't want to have to bring capital to the deal. This real estate broker basically interposes himself and says, I'll buy the property, I'll pay cash, and then I'll turn around and sell it to the vendee on a contract for deed. He extracts a concession from you, a substantial price reduction, and extracts a concession from the vendee in charging a higher interest rate. So he wins, but you then get your clean break and you don't have to bring cash to the closing. That might be another way of saying don't do seller-backed financing. There's other variations on this theme where the intermediary could accept the promissory note and hold it in the exchange account together with the $100,000 of cash. There's other ideas that are out there. Potentially, we could even give this seller-backed financing note to the seller of the replacement property as partial payment. We call that an allonge when we transfer the note to the seller. I've done that 3 times in my career. I've always been astonished that sellers would take a financing instrument as partial payment. Getting back to the identification rules. Most mom and pop investors keep it simple. They identify 3 or fewer properties. When you identify 3 or fewer properties, you're not constrained by a value cap. You could identify the Sears Tower in Chicago, the Empire State Building, and the IDS Center in Minneapolis. These are 3 properties. Doesn't matter that they're extremely expensive properties. They're 3 or fewer properties. If, however, you're going to identify more than 3 properties, you're going to identify a property in Wisconsin, Ohio, Florida, Texas, non-contiguous parcels, more than 3. You can do that, but the total aggregate value of all of your identified properties cannot exceed twice the value of what you relinquished. If you sold a property for $10 million, you can list up to $20 million of replacement properties. Is that enough bandwidth for you? Probably. However, if you'd sold a property for $100,000, now your cap is $200K. Is that enough bandwidth? Probably not. You'd better off using the 3 property rule, constraining yourself down. Well, here's where it gets hairy. By the way, there's one other seldom used rule, the 95% rule. I don't want to talk about it too much, but it's typically used in big portfolio purchases of oil and gas and mineral interests. If you're buying a huge portfolio and one of the wells runs dry and you decide not to buy it, no matter, doesn't matter, as long as you're getting 95% of the total value of everything that you identified, your exchange is still valid. So you want to buy 16 CVS drugstores? Great. But if one of those deals falls out of bed, you might fall beneath the 95% threshold and be shot in the foot. Here's where it gets crazy. Some Delaware statutory trusts, DSTs, are comprised of a multitude of components. It's got a lot of assets in it. Might have 6, 7, 10 properties. You may blow yourself out of the 3 property contention just by identifying that one multi-property DST. Nobody really knows for certain whether a DST is one property for identification purposes because it's one trust, or if a DST is the sum of all of its component parts. In conventions and meetings that I've had with the IRS attorneys, off the record, they've told me they think a DST that has a multitude of properties is the sum of its parts. It's not one property for identification. It's a multitude of properties. But there's been no reported cases, tax court cases. That was just off-the-cuff remarks. Okay, so to be careful, you're going to identify a DST from Morgan Stanley. You want to talk to your advisor and ask them how many component parts are in this property. If the advisor says, oh, it's just one asset, perhaps it's a Amazon distribution center in Ohio. That's one property. Okay, great. I like a single asset DST because it still only takes up one slot under the 3-property rule. If, however, the advisor gets back to you and says, oh yeah, that's comprised of like 7 properties in all these different states. It's like a little REIT, a mini portfolio. Then you have to say, all right, well, I'm probably under the 200% rule. Now I've got to really sharpen the pencil and add up the value of all of the properties I'm identifying. The next question that you ask your advisor is, if I put $1 into this DST, how much of the underlying debt might I be allocated as part of that purchase? If it's a 50% levered DST, 50% equity, 50% debt, that means every dollar I put in equates to $2 of buying power. So when I'm computing the value of my DST that I'm buying, I would say I'm buying a beneficial interest in such and such DST comprised of $100,000 of equity for a total purchase value of $200,000, and that's the number, the $200,000, that counts for the computing of the 200%. I got to make sure that when I add any additional acquisitions or replacement properties to my identification list, it's not kicking me over my 200% ceiling, and I have to count the debt.
Jeff, got another online one here.
Okay.
What are the rules for qualified intermediary to invest the cash proceeds for the benefit of the seller?
Generally, the exchanger identifies the property. It's on their shoulders to identify. It's on the exchanger's shoulders to negotiate the purchase of the replacement property, whether it's through an advisor buying a syndicated investment or through a real estate agent to buy traditional brick and mortar real estate. It's incumbent upon the taxpayer, the exchanger, to do their work. What the intermediary merely does is get an authorization to send the money to the closing. The intermediary isn't really negotiating contracts or arranging for product. That's on the shoulders of the person on the journey that's doing the exchange. The intermediary merely is the administrator for the paperwork for the exchange, and the sender and holder of the monies in the interim. Does that answer the question?
I think they're looking for interest paid on the money on the shelf.
Okay.
That's my assumption.
The dirty little secret in the industry of intermediaries is that there isn't a lot of interest paid, and some of that interest, or the equivalent of that interest, is going to the intermediary as part of the way they make their money. So there is oftentimes growth factor paid on large transactions, but if you're doing $100,000 exchange and it's only going to be there for a week, the administrative costs of 1099ing and sending the extra interest and computing the extra interest is more onerous than the benefit typically. So oftentimes there isn't much or any interest paid on small deposits. The threshold is around $4 million typically where I see interest kicking in, but that may differ different geographic areas. Also could depend on the duration of the deal and the sophistication of the deal. We've talked about the 180 days ending early. That is a trap for the unwary. That stinks when it happens. Know about it so you can advise your clients to get around it. All right. Let's say that I owned, question, sir.
So when I'm reporting identifying my property, I'm reporting them to somebody, and then somebody arbitrating all of this, kind of watching over to making sure I'm hitting all these benchmarks. Is that the IRS, or is that my advisor, or who is doing that? Who am I reporting all this stuff to?
You're allowed to identify to the intermediary if you want to, and that's what we typically see. But you can technically identify to other parties involved in the transaction. So if that's the question, who do I identify to? Typically it's the intermediary. Who makes sure that you're doing everything right? You have to cowboy up right now and know that it's truly your responsibility to make sure you're doing it right. When you drive down the road, you need to stay in your lane or you might hit other cars. Same thing with doing a 1031. You have to know where those line markers are. Who can help you? Your accountant, your tax attorney. The intermediary isn't really the responsible party for making sure that you stay in your lane. So who's making sure you're doing it right? I would say your accountant is probably ultimately the one that's going to sign your tax return as the tax preparer. And that's the person that you want to probably work with primarily to make sure you're in your lane. Does that answer your question?
Yeah, thank you.
Okay. Let's say that you're a farmer. You own a piece of land. And on that land is a chicken coop, and maybe a hog building, and maybe some other agricultural buildings. What can you do with real property improvements that helps your current tax situation? You can't depreciate land, dirt, but real property improvements can be depreciated. So you can accelerate the depreciation on components that you are owning. There's this whole industry of the cost segregation study engineers that run around the country doing engineered studies to help you parse out the components of a building. Is this a load-bearing wall? Maybe. If it's not a load-bearing wall, maybe it's just a immaterial component that can be depreciated rapidly as chattel, personalty. Chicken coops, though, hog buildings, other shorter-lived agricultural buildings are a sweet spot for taking accelerated depreciation. And you can use those accelerated deductions to offset your gains in other areas. If you're a real estate professional, like a real estate agent, you may have almost unfettered ability to take those paper losses and use them against your other income. So real estate agents love this. But now when you go to sell your real estate, you really have two buckets of gain. You've got the land and the long-lived improvements that are either undepreciable like dirt or 39 years straight line for like a long-term building, commercial building. But those components that can be rapidly depreciated, those are a different bucket of gain. We call that the 1245 gain. 1245 trumps 1031. If you don't offset and match up your 1245 gains with new 1245 real property components or properties, you're not going to be able to fully defer your gain. So if you're going from a small agricultural hog building and chicken coop operation to a large chicken coop and hog building, you might be okay because you can match up your 1245 components with new 1245. Your gains can basically be moved over. And it doesn't have to be identical properties. You don't have to go from a chicken coop to a chicken coop. You just have to go from 1245 component to 1245 component. What that might necessitate, though, is thinking ahead and doing a cost segregation study on your replacement property to see what components are there and to make sure there's enough components that you can offset your 1245 gains. If there's not enough 1245 gains there, you may have to buy a second and identify a second property to get enough 1245 components. If you were simply going to go into plain vanilla dirt, all 1250 property, your 1245 problem hasn't been even addressed a lick. You'd probably want to identify a different property, maybe a warehouse that has refrigerator chillers in it, lots of 1245 specialty components, so you can maximize and write off your 1245 gain by deferring it into the second acquisition. Questions about 1245. This is a planning opportunity. And the mic is coming out to you, Tony. Just a second. My friend Tony Camp of Stewart Title is here today.
A lot of bankers and title people here, huh?
There's a lot of title guys here.
Thanks, man. In that event where you go from chicken coop to raw land and there's a percentage that's 1245, would you be liable for the tax on the entire deal or just the depreciation on that 1245 property? If you decided to move forward, this is the right deal, meets all the other boxes. My one that had the 1245 fell through. I've identified these three, and I'm kind of stuck. Do I just then have to pay on the gain, the recapture?
This might be a planning opportunity, Tony, because before you sell your chicken coop to the buyer, you may want to say in the purchase agreement, let's agree on the allocation of price between the land that I'm selling you and this worn-out chicken coop. Because you, as the seller, probably want to minimize the value allocated to the chicken coop, the building improvement that you've written off.
Right.
And you might want to maximize the value attributable to the dirt. Your buyer's going to have the opposite intention, because as soon as they buy it, they're going to want to take bonus depreciation on that used improvement. So there's a tension between you and the purchaser, but generally the IRS will respect an arm's length negotiated allocation of value. And if you truly did write down that chicken coop, its remaining basis should bear some relation to its actual worn out value, right?
Right.
Great question. I think that somebody should invent a DST, a Delaware Statutory Trust, that has two unique components. One, it should be maximum leveraged, 85% levered. Two, it should be consisting of a lot of 1245 components. Maybe it's like a fiber optic building or some kind of sewage treatment building or something like that, something that would have a lot of specialty components that could be rapidly depreciated. Why would that be helpful? Because there's a lot of people that can't find adequate 1245 rich replacement properties. And they don't want to pay the piper, they want to continue their investment, but they need a 1245 rich replacement investment. If there's a DST syndicator out there, that might be an area that you want to think about. You can call it the Jeff Peterson 1245 Rich DST in honor of Jeff Peterson.
Hey, Jeff, another online one here. Will you discuss related party strategies to get an additional 180-day period to extend the time frame on an arm length transaction?
All right, I'll go down any rabbit hole anytime. They threw down the gauntlet. Let's do it.
This is from Clint. Good one, Clint.
Thanks, Clint.
Whoever Clint is.
Clint is in Dallas, I believe, and he is a player in the national commercial market. So thank you, Clint. All right, so let's say that you do an exchange. And you're in the midst of your 180-day period. You're in the midst of your 45-day period, and you're pessimistic about your ability to complete an exchange. But you have a related party that owns appreciated real estate that would be perfect. So, ma'am, let's say that your mother owns an apartment complex, and you say to your mom, you know, I'm not finding anything I like, and I'd rather buy the devil I know than the devil I don't know. So, mom, related party mom, would you consider selling your property to me so that I can complete my exchange? And normally the related party rules would maybe be more present and front and center in your mind. But there's a private letter ruling that says if mom, your related party seller, also does a 1031 exchange, and she ultimately buys her replacement property from an unrelated person, her actions in effect cleanse your related party transaction, because at the end of this chain or sequence of events, the actual ending seller is an unrelated party. There's no scheme here to avoid the imposition of the tax. Okay, so you are young, vibrant, and able to take on the management responsibilities of this apartment building. And mom is older and wants to travel to Europe and not have to worry about the boiler going out on her apartment complex. And she's tired of the management. So she's happy to sell you the apartment building. What would be a great management-free replacement option that your mom could consider that she would be buying from an unrelated third party? Anybody? Bueller? In the back, my friend Tom Rashad of Morgan Stanley says a DST would be a great option to consider for mom, because the DST sponsor is unrelated, is providing a passive, management-free product to mother that is designed for wealth preservation and tax efficiency, and to derive a steady, predictable stream of income so that mother can rely on it in her retirement years. So that's a related party combo. First, you get 180 days on your exchange, and then mom gets up to 180 days on her exchange. And if you get enough related parties involved, you could just continue to defer until ultimately the last one buys from an unrelated party. So there's a way to chain these together, and that's what Clint is asking about in his online question. That's a great question, Clint. Thank you. Let's say that you own a retail business in Minneapolis, and the neighborhood has changed around you, and the local municipal regulations have changed around you. Parking has changed, traffic patterns have changed, and the building is too small and you're constrained in it, and the location isn't really right for you anymore, but you've got a lot of appreciation in that Minneapolis location. Maybe you'd be better off repositioning your property into an outer-lying suburb where you're more welcomed by the local government. The zoning and municipal regulations are easier. In a build-to-suit exchange, you sell the relinquished property, place the money with the intermediary, and then the intermediary, acting through an exchange accommodation title holder, purchases the replacement land. And you are not only identifying the replacement land, the legal description, you're also identifying the real property improvements to be produced. The intermediary insulates you from receiving that land prematurely. And then during the remainder of your 180 days, you arrange for the construction of real property improvements to build your new facility, your expansive, specifically built to your needs location that will maximize your use, increasing productivity, increasing employee happiness. So building out a new facility in the outerlying burbs might be the way for you to take your business to the next level, but you don't want to get slapped on the wrist with taxes in the midst of that transition. How long is the exchange period in a forward exchange? 180 days. Is 180 days enough time? You need to receive a replacement property of equal or greater value and equal or greater equity. If you sell your Minneapolis location for $1 million and the new land in the suburbs cost $500,000, then your bogey for constructing improvements is $500K. Does he have to have his new location completely finished and done? No. He has to have it done enough so that the land and buildings are worth $1 million or more. So he's continuing his investment into an equivalent valued property and equivalent equity. So we really just need to spin $500,000 into existing real property improvements. Is a 2x4 that's lying on the job site loose real estate? No. Is the plumber that's not going to do the work until next month, is the invoice for the plumber real estate for work that will be done in the future? Is that real estate? No. Prepaid materials, prepaid contractors don't count. You have to do a like-kind exchange, which means you need to build enough real property improvements to exist as real estate. How do you prove that? The title company may be dispersing for your mortgage lender, and they keep very accurate records. Your general contractor could provide a written statement that on this day they had completed $500,000 of construction improvements. And you might want to go out there with your video phone, your drone, whatever you want, and take pictures of the site to show the skeleton of the building is up, the framing, foundation, and all that's existing as real estate. Because it's on your shoulders to prove that you received real estate of equivalent value and equity. And you need to receive the property that you identified, substantially the same property that you identified. Yes, sir. Andy asked the question, are furniture and fixtures in the replacement property going to qualify? Remember, the IRS has now restricted 1031s to real estate. Is a dining room table real estate? Is a chair real estate? Is a 4K digital flat screen television real estate? No. I would say no. But built-in fixtures, a water heater is a good example, is plumbed in. A dishwasher is affixed and permanently plumbed in. Those are things that were personal property until they got incorporated permanently into the structure. So some things may count because they're immobile, they're permanently affixed and attached, and other things that are chattel, non-real estate, movable items of tangible personal property like a table will not count. All right, so Andy, you've completed your 1031 exchange. It's gorgeous. And your accountant pats you on the back for being so great at deferring gains in constructing your new improvements. But your employees are grumbling that they have nowhere to sit down and there's no table in the break room. What are Andy's options post-exchange? You could go to your friends at US Bank and say, banker, I own this property, it's rich with equity, but I have no money to pay for the furnishings for the chairs and tables in the break room. I'd like to do a post-exchange refinance. I'd like to borrow money against my equity. I'm coming to you after the exchange is done, and this is a separate and distinct transaction from my purchase closing. But I'd like to borrow some money against my replacement property so I can furnish the thing. So can you have your cake and eat it too? Yes. But you may have to delay your gratification and go back to your bank later in a subsequent transaction unrelated to your purchase financing. The time to have this discussion is not before you've bought the property. The time to have this discussion is after you've bought the property in a separate sort of thinking. I need some money for furnishings. You can still get to the same result because when you borrow money against your replacement property, that's not gross income. You have a corresponding obligation to repay that loan so you can get your hands on that equity. A very successful strategy that many real estate rich investors use is they put a line of credit, a credit facility on all of their rental properties after they acquire them in a separate subsequent transaction. And Matt's looking at me because you know that there could be an unforeseen vacancy, there could be an unforeseen holdover tenant that refuses to pay you. You could have a pandemic occur and not receive any income for months at a time. You could have an unforeseen repair expense. You may want to have a line of credit for business purposes available to you so you can tap into your equity. Because many real estate investors have stretched themselves real thin. They are real estate rich and cash poor. All right. I want to talk to you about time because you need to keep me on line here. You tell me when to stop. I want to stop when you want to stop. I get this question all the time. People want to build improvements on land they already own. This is a very important strategy to know because what if you can't find replacement property, but you have underutilized raw land? What if you own an office building that has a huge surface parking lot behind your office building right outside of downtown Minneapolis? That surface parking lot is being underutilized. It's a beautiful target to do a build to suit on. The problem is you already own it. There's a couple of cases that stand for the proposition that you can't build on land that you already own. The IRS took the position that that's not an exchange because you're not receiving anything new. You already owned the dirt. They think of it the same as paying down a mortgage on a property that you already own. In their minds, you're not receiving anything new. You're just enhancing your financial position on that which you already have. So that was the position of the IRS for decades. And then a private letter ruling comes out. It's shown on the board here. And what they did in this private letter ruling is they created a new estate. They created a leasehold estate, like a three-dimensional chess player is playing chess on a number of different fields or layers. They created a new layer, a new estate, the leasehold estate. The leasehold estate is owned by the tenant. The tenant can construct improvements on this land, this leasehold estate, and that could be the replacement property. So there are ways to do it. The problem is that the IRS changed RevProc 2037, the reverse exchange safe harbor that's used in this paradigm. And they said you can't park a property that's been previously owned by the same taxpayer if the taxpayers owned it in the last 180 days. So if you want to be in the safe harbor, and Paul owns the relinquished property, and Paul owns the replacement land, I would say the first step in your strategic planning is to move the replacement raw land into a different entity so it's not so matchy-matchy, apples to apples, Paul to Paul. Paul, you're going to put the replacement land into a partnership that files a 1065 tax return. Paul and Matt Thompson are going to be partners in that deal. You're going to own 99% of it, Matt's going to own 1%, non-voting interest. bringing them in so that it has dissimilar ownership, not completely matchy-matchy. Now you let it sit. They call that the baking. You want to season it for a period of time. How long does he want to wait? 180 days. Because the RevProc says we can't do a parking arrangement on a property that's been owned by the same taxpayer in the preceding 180 days. So we need to chill out after you put the replacement property into this other entity. We wait. Then we commence the leasehold estate. That's the safe way to do it. Now, we can do non-safe harbor construction exchanges on land that you already own if you don't have time to bake it, to season it in a separate entity. But then you lose perhaps a lot of the clarity and certainty of the safe harbor. But people love to build improvements on land they already own. It's kind of like buying the devil you know rather than the devil you don't know. I've mentioned the estate of Bartell, and I've mentioned that we have both non-safe harbor and safe harbor reverse exchange modalities. I would say that 99% of the reverse exchanges that we see are done within the safe harbor. But there's still a fair number of reverse exchanges that are going to be done outside of the safe harbor, typically because you're constructing improvements of greater value. Greater value then can be constructed in 180 days. We see a lot of related party transactions. The related party transactions were designed to stop abuses that were happening. If you owned two subsidiaries, one subsidiary has a $40 million property that was bought 30 years ago and has low basis, and that's the one you want to sell. That's owned in entity A. And recently, you bought another $40 million property in California in entity B. Paul, you could just do an intercompany transfer, a swap between these two wholly owned subsidiaries and move the basis. The new basis from your new acquisition would move to the old property. And then when you sell the old property, now you have little or no gain. That was called basis shifting. They wanted to stop that. So they created these rules that basically say when you do a related party transaction, you and your related party cannot change properties for 2 years. You're locked in. Can't transfer for 2 years. That's not a big deal. There also cannot be an intent to avoid the imposition of the tax. Well, let me ask you, I'm going to drill into your brain. What's the difference between legitimately wanting to defer tax and illegitimately trying to avoid the imposition of the tax? Tell me the difference, Paul. You can't. It's indistinguishable. So then they ask, all right, if you're going to do a related party transaction, please provide a written narrative on the Form 8824 of why your related party transaction is okay and isn't part of a scheme to trick the IRS, to abuse the rules. Where we see this used successfully is in farming. If Paul wants to buy a farm that's in close proximity to his home farm because of synergistic reasons, like it costs less gasoline to drive his tractor and his combine to this next neighboring farm than it does to cost to buy a farm on the other end of the county. It's synergistically more efficient to own closer in farms. Well, who is likely to own the closer in farms to your home farm? Your brother, your mother. Related parties are probably the owners of the other, or your siblings may have inherited the other parcels. So we see this a lot with related party farm transactions. We say to the accountant on the 8824, specify the synergistic reasons why he wants to own the closer in properties, but also lay it on thick with the emotional. The adjacent property has been in his family for over 100 years as part of a family tradition of farming. He wants to keep that parcel in the family as part of their tradition of farming. So there's also emotional appeals and business appeals that can be played. With you buying the apartment building from your mother, you can talk about how you know and trust the seller isn't trying to pull the wool over your eyes and all of the tenants are about to expire and leave in the middle of the night. And the boiler is not in disrepair. It's actually been repaired and maintained adequately. So there's arguments to be made. Buying from a related party is safer than buying from a stranger that might be trying to snooker you. There are two really favorable private letter rulings that deal with consolidating ownership. Let's say a trust distributes out 1/5 interest in a farm to you and your other 4 siblings. We each also got 1/5. You could say to your siblings, I want to retain the south quarter of this thing. I'll trade my interest in the remainder of the land to you siblings if all of you siblings will give me your interest in this little corner piece that I want to own entirely in my name, fee title. So post-distribution from a trust, there's an opportunity to consolidate a portion of that property solely in your name by doing simultaneous related party transfers. And the IRS and Treasury seem to like and think that those are okay because you're trying to consolidate a parcel wholly in your name. Why would you want to own 1/5 of that land? You can't control it or possess it. It's not really meaningful to you until you consolidate it entirely in your name. So inter-family partitions to consolidate ownership seem to be okay. Also, there's really not an intention to trick the system because the other parties that are going to receive your fractional interest in the other parcels, if they sell, they're going to be paying the same tax that you would have paid. You all are kind of inherited at the same time with the same basis. So there isn't an intention to trick this service. Will Puerto Rico ever enter the United States as a state? Are there any political science pundits in the room? If it does enter the United States as a state, this would be the time to do your foreign property exchanges because real property in the United States is not like kind to foreign property. Right now, you cannot exchange your property in Belgium for a property in New Hampshire because it's in a different country. But if you had an inkling that Puerto Rico was going to come into the United States, we're going to add another star to our flag, then you'd probably say, I'm going to sell Belgium. I'm going to buy my replacement in Puerto Rico, which right now is not officially part of the United States because they have a different tax system in Puerto Rico. And then when and if it enters the United States, now you own U.S. property that you could exchange. Are some people doing that in hopes that it could come to fruition? Perhaps. All right. The last topic is partnerships. Partnerships are great for buying real estate. They're efficient vehicles for holding and owning and managing real estate. But when it comes time to sell, there isn't any elegant exit for the individual partners. Who has owned the property, the real estate, the partnership? The constituents or partners inside of that entity don't own an interest in real estate. And partnership interests were excluded from 1031 treatment. So this is the biggest planning opportunity to figure out your elegant exit before you list the property for sale. Again, the aristocrats, the high-level thinkers in the 1031 industry, think about this concept of qualified use, the holding period. If I distribute out your partnership interest to you, and you now own an undivided 1/7 of the property because you owned 1/7 of the partnership, how long must you hold that property, hold that real estate before you are eligible to do an exchange? There is a debate going on in the highest levels of 1031 thinking. Some tax practitioners think that you can tack the period of time that the partnership owned the property to the period of time that you owned it. And so that you can immediately just do an exchange after distribution out of the partnership. Other practitioners think, well, you just held it for a millisecond. How can you say that you held it for investment or business purposes? Because you immediately sold it right after you got it. And oh, by the way, the entire time you held it, it was subject to a purchase agreement negotiated by the partnership to sell the property, that this was just a continuation of the partnership's activities. The high-level thinkers that think that he can drop and immediately swap rely on this case called Magnuson. Magnuson, though, was a case where a guy did an exchange, and then he immediately contributed his replacement property to a partnership. And the IRS said, hey, you can't do that. And the tax court allowed it. But in those days, this case was decided, Magnuson was decided on facts and law that don't exist any longer. This was pre-84, prior to partnership interests being excluded from 1031 treatment. So the tax court probably took a more liberal view. Oh, you're just continuing your investment in the modality of partnership modality, no big deal. That's different law than we have now. I don't think Magnuson is a credible authority to rely on. I think it's a suspect, dubious authority to do major tax planning on. But reasonable people are going to differ in their interpretation of what to do. My advice is to get with your tax attorney, build your team, and break up, reconfigure, reorganize the ownership of your partnership assets early, well before you've listed the property for sale, well before you've signed a sale contract, reconfigured the ownership. That'll be the strongest and most defensible position. Right now, if you're in California, the FTB, the Franchise Tax Board, most erratic, most aggressive taxing authority, they're going after these drop and swaps. But they're much more liberal and accepting of a pre-planned partnership division where we spin off subsidiaries and drop the real estate into these entities that are considered continuations of the predecessor for tax purposes, called, sometimes referred to as a 708 spin-off. That's being more accepted by the California Franchise Tax Board. Maybe if I'm in the western states, I'm going to be more thoughtful, pre-planning, and orient myself towards that kind of reconfiguration rather than a crude drop and swap. If you drop down out of your partnership to a tenancy in common and you don't notify the bank or get their consent, you're technically in default of your due on sale clause, which is not a problem if you don't have a bank lender, but if you own encumbered property, you should probably ask the bank. You should probably change your insurance with your insurance provider because now the partnership doesn't own it anymore. The insured should be the individuals. Your accountant should be notified immediately that you've dropped out of the partnership. Stop the 1065 bookkeeping and tax reporting. Henceforth, you're going to be reporting this income on Schedule E as individual income, not K1 partnership activity. So there's a lot of things that you have to do to affect a real exchange. Bottom line, 1031 is a great tool for deferring your gain. Without the drag of taxation, you can amass and build an enormous amount of wealth using and redeploying the money that you otherwise would have paid to the state and federal government in taxes, keeping all of that money compounding and building and working for you. And the ability to use OPM, other people's money, U.S. banks' money, leverage, supercharges your ability to build wealth in real estate. The thing to remember is as you parlay from one property to the next, you're taking that deferred gain with you. your basis in the replacement properties will be lowered by the amount of gains that you didn't recognize on your previous sale or sales. So you're building up this deferred gain. You're carrying that baggage with you. All right? You started with a single family, you parlayed it to a fourplex, you parlayed that to a 12 unit, you parlayed that to 32 units. Eventually you're up to 64 units. Is it conceivable that you could do that over the course of 30 years? Is it conceivable that you could do it over the course of 20 years? I know people that started in the 80s and they're up to like 5,000 units. It's crazy how fast you can parlay this equity when you're not dragged down by taxation and you're able to supercharge it with other people's money. All right, now you've amassed all of this real estate wealth. You've got all this deferred gain. What are you going to do? Defer, 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 die, because Section 1014 allows for a step up in basis. When you die and your heirs inherit that property, they receive the property not with your low basis, Dad. They get it with a stepped up basis. It steps up to the fair market value at the time of the decedent's death. Now, you may have other issues like estate tax, inheritance tax, so you should have your team helping you. How do you fix an estate tax problem? You buy life insurance. When you're young and healthy, Mr. Plaid Shirt Dude, this is when you go in and see your life insurance person because you can pass a medical. You don't have high blood pressure. You know, if you smoke, stop smoking. Get that life insurance while you're young and healthy because you might need it to fix a problem down the road. All right. My name is Jeff Peterson. I'm with CPAC 1031. I'm out of Minneapolis, Minnesota. I provide 1031 exchange services. I want to thank Guarantee Commercial Title for helping sponsor this. I want to thank the law firm of Meserly and Kramer, and in particular John Lang, who was supposed to be co-presenting today but had to bow out due to a family medical issue. And I certainly want to thank our hosts who have been doing this with us forever, Matt Thompson and the crew at US Bank. Thank you so much, Matt. Why don't you close us out?
Yeah, thanks, Jeff. A couple things before. A round of applause for Jeff. Will you share these slides with people online and people in the room?
Yes. Contact me, send me an email, and I will send you a PDF of the deck. They are my slides. You can't reuse them or use them without my permission, but you're happy to study them and use them for pedagogical or educational purposes.
What was that word?
You can't use my slides to compete against me,
No,
but
that
you
other
can
word.
study them
That was a
for
big word, Jeff.
educational, pedagogical.
Okay.
Good pedagogy is what they say.
All right. I'm a banker for a reason. Are you a lawyer too, I think?
That's right.
Yeah. Okay. We do have the room until 11, I think, right? Where's Jamie? Well, anyway. So if you have other questions, you can certainly hit up Jeff. Will we share the whole presentation as well?
So this entire presentation's been recorded. Stefan is going to be putting this out. He's also going to be cutting it up into little bite-sized segments, and we're going to drip those out on the internet. If you're not connected to me on LinkedIn, please send me a LinkedIn connection. I'd appreciate the opportunity to network with you, but then you'll be getting these feeds from time to time. We're going to put out good clips, edited well, and you'll like that material because it's bite-sized, small.
Yeah, and for my U.S. Bank guests, if they don't have Jeff's email, you can hit me up directly as well, or your friendly banker who invited you. So while the sun's out, Jeff, I want to thank those of you who ventured down here, made it here. Most of us made it on time. So look at the good room there, Jeff.
We really had a great turnout and an even bigger turnout online. So this event has become more and more successful. And it is fun to do this on 10/31. It's our holiday, right?
Yes. That's Jeff's idea. Okay. Hey, thanks for coming. I appreciate it. You guys, everyone drive safe.